Today, we're going to tackle one of the biggest ideas in all of human history, value. What is it? Where does it come from? We're going to trace its incredible journey from something you can hold in your hand to an abstract promise, and finally, to something built entirely out of algorithmic code. Okay, so here's our game plan. We're going to look at the story of finance as a series of really tough problems and the, often brilliant and sometimes pretty dangerous solutions that people came up with. We're starting way back at the beginning and ending up right on the bleeding edge of tomorrow. So our story kicks off with the most basic economic puzzle you can imagine. How in the world do you trade with someone when money just doesn't exist? This was the world of barter, and let me tell you, it was a really inefficient, clumsy way to start doing business. Yeah, just think about that for a second. This simple question really gets to the core of why barter just doesn't work at scale. For a trade to happen, you need what economists call a double coincidence of wants. That's a fancy way of saying you have to find someone who not only has the bread you want, but who also happens to want your specific cow at that exact moment. I mean, what are the odds? It makes any kind of complex economy pretty much impossible. And it gets worse. Beyond just finding the right person, barter was a total mess. There was no common yardstick for value, so every single trade was a brand new, complicated negotiation. And what about goods like a cow? You can't exactly slice off a leg to buy a loaf of bread. Plus, you couldn't really store your wealth. Your food would rot. And maybe most important of all, you couldn't defer payments. No credit, no loans, no investment. The whole system was stuck. So clearly, the whole barter system had to go. Humanity needed a much better tool. And this need sparked the first truly huge leap in the story of value, the move away from physical things you can touch to an invisible idea that you just have to trust. Now, this evolution took thousands of years. First, you had commodity money, things like gold or salt that had their own built-in value. Then came representative money, basically paper notes that were just an IOU for a real chunk of gold sitting in a vault somewhere. But the final radical leap happened in 1971. With the Nixon shock, the U.S. completely cut the dollar's connection to gold. And just like that, the system of fiat money we have today was born. It's money that has value only because a government says it does, backed by literally nothing but our collective faith in that government. What's so fascinating is that the shift in what money is reflects a huge philosophical war over what value even means. For a long time, the labor theory was king. It said an item's worth was objective. It was all about the hours of work put into it. But then the subjective theory came along and said, no, value is all in your head. It's about what you desire. Today's economics kind of mashes these together. It says value is about how useful something is to you now and what you expect it will be worth down the road. So, switching to fiat money gave central banks this incredible power to manage the economy. But it also opened up a massive risk. If there's no gold anchor, what's to stop a government from just printing money forever? Critics warned it was like creating an inexhaustible printing press, one that could fuel endless debt and the constant threat of runaway inflation. So once we all agreed that value was an abstract idea based on trust and what we think might happen, the next step was almost inevitable. We had to figure out how to price the biggest abstraction of them all, the future itself. And this led to a brand new challenge. How do you put a price tag on something that hasn't even happened yet? The answer, and it was a brilliant one, came out of 18th century Japan. Rice merchants were getting crushed by wild price swings, so they invented rice tickets. These were basically paper claims on a future delivery of rice. Suddenly, they weren't trading rice anymore, they were trading promises. And just like that, the world's first futures market was born, giving us a formal way to price our expectations of what's to come. That simple rice ticket was basically the ancestor of the huge, and let's be honest, incredibly complex world of modern derivatives. These are powerful financial instruments that take abstraction even further. They don't just value things, they let us chop up, price, and trade risk itself. It's really the ultimate expression of value as a forward-looking guess. All right, so the next major leap in our story isn't really a new idea. It's about raw power. It's computational. This is the moment when we handed the keys to the market over to algorithms, and values suddenly started moving at the speed of light. Think about this for a second. Today, roughly half of all stock trading in the US is done by high-frequency trading algorithms, or HFT. These are computer systems moving faster than a human brain can even process, finding and acting on new information in millionths of a second. And this incredible speed creates a real paradox. On the one hand, these algos make markets way more efficient. They add liquidity, they lower transaction costs for everybody. But on the other hand, because they all react in the same way at the same time, they can create these dangerous feedback loops that just amplify panic and chaos when things get stressful. And the danger here isn't just theoretical. We saw it become terrifyingly real during the 2010 flash crash. In just a few minutes, the market absolutely cratered, dropping nearly 1,000 points. Why? Because thousands of algorithms, all reacting to one big sell order, all tried to run through the exit at the exact same time. It showed just how fragile this new machine-speed market could be. So as technology was making markets faster, it was also changing the very essence of what was being traded. The most valuable assets for companies today, well, they aren't factories and equipment anymore. They're ideas, brands, and data, all things you can't physically touch. And this shift to an intangible economy creates this really bizarre situation with our old accounting rules. It's kind of crazy. If a company goes out and buys another company's brand, that value shows up right there on the balance sheet. But if that same company spends decades building its own world-famous brand from the ground up, that value is often totally invisible on the books. For the big digital giants of today, value doesn't just add up one by one. It grows exponentially. The more users they get, the faster the whole network's value just explodes. And this phenomenon is captured by a really simple but powerful little formula. It's called Metcalfe's law, and what it explains is that the value of something like a social media platform isn't just the number of its users. The real value comes from all the possible connections between those users, and that number grows exponentially. So every new person that joins makes the whole network that much more valuable for everybody else. And all of this brings us right up to the present day. We're standing at a fork in the road where two completely different visions for the future of value are battling it out, pushing this whole idea of abstraction to its absolute limit. On one side, you have decentralized finance, or DeFi. The big idea here is to put our trust not in governments or banks, but in transparent, automatic, unchangeable computer code. The motto is, code is law. On the complete other side, you have Central Bank Digital Currencies, or CBDCs. This is basically the government doubling down on its authority, creating programmable money that can be controlled entirely by a central power. But here's the catch with DeFi. That promise of automated trust, it's incredibly fragile. In 2024 alone, more than $1 billion just vanished due to hacks and security flaws. It's a tough lesson that code is law is a powerful idea, but at the end of the day, it's only as secure as the humans who wrote that code in the first place. So this leaves us with the ultimate question, doesn't it? As value finishes this incredible journey from a physical rock to pure programmable information, who or what are we going to choose to trust? Is it going to be the decentralized, transparent, but kind of fragile world of code? Or will we stick with the stable, powerful, but centrally controlled authority of the state? The answer to that is going to define everything about our economic future.